Signs of stress in the ballooning trillion-dollar U.S. auto market are pointing to an impending collapse as storm clouds continue to gather in the economic and financial landscape. Serious delinquencies in auto loans, defined as behind on payments by 90 days or more, jumped the most since the 2008-9 global financial crisis, putting the entire automobile financing market at risk of facing a massive default wave in the coming months. Experts are raising big alarms about the current condition of the car loan sector. They say that millions of American motorists will have their vehicles taken away in the months ahead and warn about a brewing financial crisis that could reach unprecedented proportions and completely crush the United States economy. That's what we're going to expose in today's video. But before moving on, we kindly ask you to support our work with a thumbs up and don't forget to subscribe. For several months, speculation has been building that auto loans could be at the heart of the next financial crisis. The car industry understandably attracts a lot of attention in the media due to its cultural relevance. People rely on cars to get to work, to take their children to school, and to participate in their communities. Historically, vehicles represented economic success. But new auto credit data reveals that cars and the loans consumers take out to buy them could trigger a major downturn in 2023. According to an automotive news report, the world's most important auto market has been facing a marked deterioration in recent quarters. Over the past 9 months, the rate of auto loan delinquencies in the U.S. has surged significantly. For borrowers under 30, serious delinquencies have jumped more in the past 2 quarters than in any other 6-month period on record in data going back to 2000, according to the latest data from the Federal Reserve. Newly so-called delinquent or overdue U.S. auto loans reached $23 billion, and new seriously delinquent loans exceeded $8 billion. Both are absolute levels not seen since the depths of the global financial crisis, the report shows. Right now, more and more buyers are having difficulty keeping up with auto payments, and a record 7 million Americans are at risk of losing their vehicles for being 90 days or more behind on their loans. Generation Zs and Millennials account for 2/3 of the outstanding auto loan debt. 1 in 3 Americans between the ages of 18 and 30 say that their car payments take over 20% of their after-tax income. Now, the outlook for these struggling borrowers is unfortunately extremely bleak. First, there's inflation, which has pushed up the prices of most consumer goods. This eats into their ability to make car payments. Second is rising interest rates, which make credit card debt, another pain point for young borrowers, even more costly. Finally, there are student loans, which are expected to resume in the summer of 2023. A February Fed consumer survey found that young Americans and low-income Americans say they expect to struggle to make payments over the next few months. Those under 40 and those earning under $50,000 a year said there was nearly a 1 in 5 chance they would miss a minimum debt payment of some sort over the next 3 months, researchers wrote. In March, official agencies alerted about the strongest expectation of debt delinquency for people under 40 since the spring of 2020, when 14 million people lost their jobs during the first pandemic shutdowns. That has raised fears of a massive default wave this year because Americans are loaded up on auto loans like never before. At the end of 2022, the total value outstanding nationwide was an incredible $1.55 trillion, and that's more than double the amount 10 years ago. Put another way, auto loan debt totaled $4,800 for every single person in the country. At the state level, Texas led the way in auto loan debt by population. Fed data also shows that each person in Texas with a credit report owed an average of $7,300 in car loans at the end of 2022. Texas was followed by Louisiana, $6,500, and Georgia, $6,100. On the other hand, The value of borrowing has exploded all over the country as soaring prices for new and used cars led people to take out ever bigger loans. The average new car loan hit almost $40,000, an increase of 25% over 3 years. For used cars, it was $28,000, up from $18,000 3 years earlier. This squeezed many household budgets, for some to near or past the breaking point. Financial advisors say your car payment shouldn't surpass 10% of your take-home pay. But staying under that threshold has become a challenge for most. Today, a couple earning the median household income for married couples would pay 16% of their after-tax income on payments for 2 new cars at average loan values. One used on one new vehicle would cost them 14% of their take-home pay, Axios data reveals. Meanwhile, the average person living alone would pay 23% of her after-tax income on payments for an average new car loan and 17% for a used one. Typically, a car loan is the first payment people make because a vehicle is critical to getting to work and someone can live in a car if all else fails. When car loan delinquencies rise, it is a sign of worsening economic conditions for low-income and working-class Americans. Your car loan is your number one priority in terms of payment, explains Michael Tione, a senior director at Fitch Ratings. If you don't have a car, you can't get back and forth to work in a lot of areas of the country. A car is usually a higher priority payment than even a home mortgage or rent. On the same note, Satyan Merchant, the senior vice president of TransUnion, says that inflation and interest rates are having a major role in the financial troubles of many Americans. But rising unemployment poses an even bigger threat. Every year, about 80% of defaults end in repossessions. But the truth is that the entire market is set up for failure. After the financial crisis, there were a lot of restrictions placed on mortgages to make it harder to take out a home loan unless someone could clearly afford to make the monthly payments. But experts observe that there are far fewer restrictions on auto loans, meaning a consumer has to be savvier about what they're doing when they take out a loan. Oftentimes, lenders offer loans they know the borrower cannot pay for. Predatory lending practices and a lack of real transportation options leave many households trapped in debt with few ways out, highlights Fay Park, president of the liberal U.S. Public Interest Research Group. Repossessing a car is also a far quicker process thanks to technology and the laws in many states. Some cars are installed with devices that actually prevent the car from turning on if someone misses a payment. It's also become easier to track license plates and geolocate a car to repossess it. It's a lot easier to repossess a vehicle than to foreclose on a home, the executive notes. On top of that, all the people who took out car loans in the past 2 years are likely to face the added challenge of faster than usual depreciation in the value of their cars as prices start to plunge nationwide. In other words, those borrowers could find themselves underwater on their loans, owing many more thousands of dollars than their vehicles are worth. Some financial analysts even claim that many lenders are ignoring typical red flags associated with loan applicants who are already struggling to pay their previous auto loan properly. This problem is further aggravated by a decline in wage growth in the U.S. for 24 straight months. This adds immense pressure on U.S. households who are scrambling to strike a good balance between expense, income, and financial savings. That is the argument Andrew Schmidt of the University of California, Berkeley School of Law makes in a recent article. He says state officials, lawmakers, and regulators aren't doing anything to intervene in the car credit market to curb lenders' ability to issue subprime loans. Since the Great Recession, the number of car loans issued in the United States has reached an all-time high, the analyst says. The rate of lending to people with low credit scores and high risks of default has also sharply increased, he adds. Frequently, lenders price cars as high as twice the Kelley Blue Book value, a practice that allows them to profit from the down payment and origination fees alone. The subprime loans they issue also carry exorbitant interest rates, sometimes exceeding 30%. Consumers are already in dire financial straits when they're taking out a subprime loan. They're unable to qualify for a conventional car loan. With no bargaining power and the urgent need for a car, they have little choice beyond accepting the lender's abusive terms. While lenders profit from defaults, some borrowers spend decades paying off a car they only drove for a few months. To recoup loan balances, lenders engage in aggressive collections tactics such as lawsuits and wage garnishment. Some subprime lenders have attorneys on staff to keep up with the rapid rates of default, but the heightened potential for mass debt default of subprime auto loans can send shockwaves through the financial system, just like mortgages did in 2008, and Schmidt worries that this can have disastrous consequences for the economy. Risky lending creates a high demand for used cars, causing price inflation, he explains. Because lenders profit even when borrowers default, they have the incentive to originate loans that will likely default. As with the 2008 housing crisis, a systemic mass default scenario would result in a larger supply of repossessed cars. Used car prices would collapse, followed by new car prices, he warns. As loan-to-value ratios rose, borrowers close to default would be unable to refinance, leading to another wave of repossessions and price drops. For low-income Americans, having a car repossessed could mean forfeiting gainful employment, amassing crippling debt, and even losing eligibility for public benefits. That's why the auto market crash is likely to hit the poorest households hardest. Without meaningful intervention, the subprime auto loan bubble is primed to burst, Schmidt warns. Just like the other financial meltdowns that were fueled by reckless lending and speculation, this crisis will reach proportions most people don't even imagine. The dominoes are already falling in the financial world, and the automobile market may be the next shoe to drop. What are your thoughts on this? Please, we'll look forward to your comments below this video, and thank you very much for watching.